All right, thank you very much. We'll go ahead and get started here. Want to just thank Investor Inspiration for the opportunity to speak with you guys today. And I got to say, Matt, wow, that was a very entertaining webinar. Didn't know I was going to be up against fighter pilots, but we're still going to sit back and have some fun talking about trading, because that's the best part about trading, is to be able to talk about it. And as you guys know, most of you are trading is kind of a lonely business. When you go to a cocktail party or go to the PTA meeting, people don't understand what we do, and so it's great to talk to other traders and have some fun. So we are actually going to spend the next 45 minutes talking about trading. What's going to be interesting about this presentation is that there is no pitch. Okay, there's absolutely no pitch. I'm going to show you a link here in about 2 minutes, and you can actually skip the presentation if you like. The reason being is I understand your time's valuable. It's a weekend. In fact, at 3:30 this afternoon, the Tennessee Volunteers are playing, and so hopefully I will be done by 3:30 so I don't miss any of that game. And I know everybody's got things going, so there's not going to be a pitch. There'll just be a link to a site that you can sign up for a free demo, and that's it. So we're going to go ahead and jump right in. First of all, I got to tell you, this is from my neighborhood. Yesterday, we have forest fires. This is the first forest fire. I've lived in Tennessee about 15 years. First forest fire I've ever been even near. So I'm sort of freaking out. This is about, at that time, that fire right there was about 7 miles away from my house, and it has now spread down the mountain towards me. This was last night. This is not from the picture's not from my house, but it's much closer to the fire. But at this point, the fire is about 5 miles away. I apologize in advance if you hear my phone ringing in the background. They have started doing aerial runs, helicopters. They have some Black Hawk helicopters that have been fitted with water buckets. They've been running helicopters, and today they brought in the really big tanker, looks like a C-130, to bring in to spray the red fire retardant in, and there's several other smaller aircraft that are operating in the area as well. So my neighbors and family, of course, are all, very intrigued about this process and have been texting and emailing and phoning me. So if I will not answer, I won't stop the presentation, but my wife, I want to have access to my text if they decide that we need to evacuate for some reason. But anyway, that's my excitement. Certainly not fighter plane excitement, but this is the excitement that's happening in Tennessee. I'm actually southeast of Knoxville, Tennessee, in the Smoky Mountains, and this is the big excitement in my neck of the woods. So that being said, let's go ahead and jump right in. Here is the link for the demo, and I'm not going to tell you how much it is. I'm not going to tell you anything. I'm going to show you some really cool stuff that's part of our package. And then if you're interested, you can go check out the demo. These are live demos. You actually have to schedule it. A trader will then hook up with you, and you will have a live demo. So very, very cool. So first things, this is a standard candlestick chart, and I'm sure that most of you guys, even Matt before us here, was looking at his charts, was using a candlestick chart. This is what most traders use. And what I'm going to show you is I'm going to show you how we are going to rip open the candlestick and see how a candlestick is formed and how we can use that information to have an inside edge as to where we want to place our trades, when we want to place our trades, then of course if we actually want to put a trade on at a particular place. So, first and foremost, trade location. Now, I don't care whether you're a now, let me just say that we have a product that is both for futures, and we have a second product that is for Forex. Okay, so that's the reference this is going to come from. It's from a futures trading perspective. Now, trade location is very important. Whether you're a Fibonacci trader, a pivot point trader, maybe you use the 200-day moving average as a location to put on a trade. Those are trade locations, and those are very, very important. Now, we're going to show you how we come up with trade locations, what we do with them, and the end game here is that, you can come up with trade locations, Fibonacci's, pivot points, whatever. And the thing here is that you don't know whether that trade location is going to get run over or not. There's just no way to know, right? 50 fib, 61.8 fib, the S1, R1 of the pivot points, pivot point formulas. You don't know. Maybe you've done research, you see a support and resistance area, but you don't know whether that point of resistance or support is actually going to hold. Well, with order flow, you'll be able to tell in real time if that level is going to hold or not. And we'll show you how to do that. Trade locations, we find our trade locations and we mark them as horizontal levels on a chart. So these could be Fibonacci's, these could be whatever. It could be a black box, it doesn't matter, because what our system does is it will enhance any method you're currently using by allowing you to use order flow to confirm the trade, to confirm that entry. So whether or not it is this, turn my pen on here, whether it's this point right here or whatever point you're at, determining if this point is actually a place where we want to take an entry. It's not a gamble. We're not just parking an order. Okay, we're actually looking for a specific sequence of events within order flow to tell us whether we want to actually take that trade. Now, this is futures trading, this is Forex trading. However, if you're like the previous guy, Matt, and you're an options guy, how is this going to help you? Well, we can determine if this is the spot to enter the trade, and you can sit there and wait to take your options trade, making sure you get the best price for your option. So it even works. You can even apply this to a totally different instrument like options to help you get the best possible entry point. Number two, we're going to use time periods. Now, some of this trade location, time periods is not rocket science, okay? This is not new cutting edge stuff. This is stuff that's out there. But we're going to take all the best pieces of that and put it all together into a nice system. So time periods, we're going to identify specific time periods in time where a particular swing high or swing low will occur. Now this is old-fashioned detective work. We've done back testing, we've gone back and we've identified zones during the day that have a very high probability that a swing high or a swing low will occur. So we take a high probability trade location, combine it with a high probability time period, and we are already shooting well above that coin flip of whether it's going to go up or down or it's going to break that level or not. So again, we're sort of taking some of the best things and putting them together. So we take time periods with our trade locations, and then we wait for order flow to tell us whether to take the trade or not. So you're always going to default back to order flow to say, is the market going up? Is it going down? What are the buyers doing? What are the sellers doing at that trade location at that period in time? Okay, so I use trade location, time periods. Then we're going to use order flow to confirm that. Now, order flow is one of the new buzzwords. Everybody wants to see and look at order flow. And it's a different way of looking at the candle and the market in general. And what we're going to do here, I have a chart where the time frame, the trade location, the horizontal line, all come together and price comes up to this level. So when price comes up here to this level up here, to the trade location in the time period, now what? Well, now we look at the order flow. This is what's called a footprint chart. Okay? Footprint chart is really a fancy way of saying a super duper candle. So if we look at over here, you'll see this one. Here's the body. There's a little wick on the top. Here's a tail on the bottom. That's a candlestick. It's green, so it's an up candlestick. So this is just a candlestick that we have literally exploded, and we're looking at the numbers inside. Now, a lot of you are looking at the numbers going, ooh, that's way too much, way too much. But let me tell you a story. I just recently spent some time with one of our new clients. He is an ex-floor trader, lives in Chicago, has done 10 years off floor trading, saw our product, was very skeptical. He emailed our sales division and said, hey, I want to talk to somebody who can show me how this thing really works. And so he was very persistent. He got through multiple layers and finally got to me. And so I scheduled some time with him, and I spent about 40 minutes showing him on a private one-on-one basis. And in the first 10 minutes, now this is an accomplished floor trader. He's been trading for 35 years, 20 years or so on the floor. Another 10 years of off-floor trading. And after 10 minutes, he said, I said, you're not saying anything. I said, Marty, you're not saying anything. What is going on? I said, you there? Can you hear me? He's like, I don't even know what to say. He said, I don't know what to say. And I said, what do you mean you don't know what to say? He says, this is amazing. This is unbelievable. So let's talk about what you actually see now. In literally 10 minutes, he saw the value of a footprint, and I mean, I hadn't even shown him all the cool stuff. I was just showing him a footprint and how valuable the footprint is to be able to see what is going on in the candle. So let's take a look on this far right one here, and we have two sides of the candle. Okay, so we have a left-hand side. Okay, this is the bid. The other side here, this is the ask or the offer. And what this is information that's from your time and sales window. So everybody's seen a time and sales window, and if you trade the ES, let's see, 10 years ago, the ES was fairly new, electronic platform, relatively low volume. I remember when the ES actually came out, and they were talking about a couple 100,000 contracts a day. And at that time, you could use time and sales, and time and sales was actually useful. You could see sort of what was going on by watching the time and sales. Well, over the years, that volume has gone from a couple 100,000 contracts to 2, 3, 4, 5 million contracts in a single day. So now if you watch the time and sales, it's mind-blowing the number of contracts it streams by on your time and sales. In fact, it's so fast it's not usable anymore. You can't figure out what's going on because the numbers are moving so fast. So we take the information from the time and sales. In time and sales, you can identify if it's depending on your software product, it'll give you a green or a red. If it's on the bid, it's usually a red number. If it's on the offer, it's usually a green number. So the time and sales tells you where that contract was executed on the bid or on the offer. And we took that information and we stuff it in based on price. So at this red 2378 here, that's the number of contracts that were executed on the bid. Okay. Can't see my cursor. Tony, is that right? You should be able to see me drawing, hopefully. So the 2378 is actually executed trades. Now, this is not like the DOMs. You've seen the super DOMs that have the order book, and it's oscillating up and down, up and down, up and down. You see the orders on the offer and orders on the bid. This is not that. This is executed. Okay, so there's no monkey business in these numbers. These numbers, actual executions, which means that the information we're going to be getting from it is not spoofing or any of that other stuff that comes from those order books. We're not interested in that stuff. We're interested in where the money hits the road, okay? Where you put your money where your mouth is. Well, this is where people put their money where their mouth is. They actually execute an order. So we can decide, we can see an order that's executed on the bid. So why is this important? If it's executed on the bid, what has to take place for this to happen? First of all, you have to have somebody on the bid that's willing to buy it, and he's willing to only buy it at a particular price. Now, he's a very passive. He just puts his order out there and he says, hey, I'm going to wait till somebody takes my bid. Well, who takes his bid? A seller, right? Somebody who wants to sell. They sell their product to, they sell their contract to the bid. Now, I know this is really groundbreaking information for you, but every contract that's executed on the bid is executed by an aggressive seller who is unwilling to wait on the offer for a fill. So when somebody hits the bid, the buyer is not the aggressive person here, it's the seller. So the bid side is aggressive selling, and the offer says on the offer side, who takes the offer? Who hits the offer? The aggressive buyer. He's not willing to sit on the bid and wait for his order to be executed. He says, I need to buy now. So he buys now. He's aggressive. So we have aggressive buyers on the right-hand side. So now all these numbers represent aggressive buying and aggressive selling. That changes the whole picture of the chart. In the past, we look at a candlestick chart and it's plotting what? Price versus time, right? Now, we're not just looking at price and time, we are looking at aggression. So think of this chart as a chart that's plotting aggression, behavior. That is the power of the footprint, being able to track behavior. Now, I have 2 children, and any of you who have children, when I tell you this story, you're going to be able to identify. My youngest is a boy, and as all boys, they want to play and touch and throw and stomp on everything in their path. And so you have the ball, and you say, no, you can't have this. Okay, it's not time to play with the ball. So you know exactly what's going to happen. He starts getting closer and closer and closer to the ball. You're like, no, no, it's not time to play with the ball. And okay, Dad, okay. Now, 5 minutes later, you're not watching. You know that ball, he's going to go for the ball. All right? You know this behavior is going to happen. You've seen it happen over and over again. Now, if I can see a specific behavior and know what's going to happen, isn't that a monumental edge? If I can see behavior that's happening in the market, the outcome is predictable. Human behavior is predictable. Now we have changed a price and time chart to a behavioral chart. This is behavior. Aggressive sellers, aggressive buyers. This is the cool stuff, okay? Now I can see what's going on in the candle, how the candle's being formed. Very, very, very cool stuff. So let's jump right back. We got a little sidetracked on our little education here, but let's go back to our trade location here in our time frame. Price is coming up, and I have this little red box. We call this a sequential decline. Now, it's pretty simple. This is mathematical. Okay? If you look at the number here, that first one says 10,426. That's the number of contracts that were executed on the offer, which means that's aggressive buyers. We go up one price level, 3,320. Go up one price level, 463. Prices are getting the number of executed contracts, the number of aggressive buyers is going down as price is going up. What kind of behavior is that? Well, it's predictable behavior. When price goes up, there's less people willing to buy it. Let's think about this in real terms. You go to an auction. There's a Ferrari to be sold. At the beginning, the auctioneer starts off with a 10,000. Do I have 10,000? Well, of course, every person in the room who's got a paddle with a number on it's going to raise his hand, because who wouldn't buy a Ferrari for $10,000? All of a sudden, boom, there's everybody in the room's got their paddle up. I'll buy it, I'll buy it, I'll buy it. And what happens? Price goes up. So we skip forward. Now it's at $1 million. The bid's $1 million. He says, do I hear $1.2 million? Do I hear $1.2 million? Well, all of a sudden now there's maybe one or two bidders that are bidding because it's gotten way too pricey for all the rest of us. So there's only one or two guys that have a paddle that are now sticking their paddle up. So as price goes up, there's less buying going on. It only makes sense. We see this all the time. We see this all the time. Now, let's skip ahead to the sellers. Now, if I have a Ferrari and I bought it for, say, $500,000, it's been sitting in my garage, and I pay a guy to come detail it once a month just to keep it nice and shiny, whatever, and I see an auction that goes off at $1.2 million for a very similar Ferrari that I have in my garage, what am I going to do? That price is so high that it's going to provoke me to sell it. So we have this situation where buyers the price gets too high and they stop buying. The price gets so high that sellers are drawn in. I'll sell it. I'll sell it for $1 million. I'll sell it for $900,000. So suddenly now price creates an opportunity for sellers. So what we see is we see a sequential decline here where buyers dry up at the top. And then on the other side, remember this is aggressive sellers selling right here in this column. This is aggressive buying in this column. So we simultaneously see the buy pressure start going down. There's less executions. Okay? Less executions. So as this price goes up, then what happens on the sell side? Here's the sellers coming in. 1422, 11,000. Okay, now wait a minute. Are you telling me that on any given candle I can actually see the buy pressure go down and the sellers come in? Yes. That is exactly what you are seeing at the top of this candle. Now, this is particularly interesting at our trade location. Because our trade location, it might be a Fibonacci number, it might be a pivot point, I know that that spot, that trade location, is a potential turning point. How can I prove that it's actually going to be a turning point? Well, when price comes up to that, the buyers disappear and the sellers come out of the woodwork. That's how I know that trade location is a good place to do an entry, because I can watch the buying pressure drop, simultaneously seeing the sellers coming in. And that's exactly what we have right here. So no more guessing if that Fibonacci number is going to hold. No more guessing if the pivot, if the 200-day moving average. I can see whether it's going to hold or not. Okay, now I know some of you guys are thinking, when do I get in? Well, you can do the end of the close of this bar. You can wait till the next bar opens right here. Okay, what's the difference in price? Okay, if I try to get on this bar here, maybe I get an entry right there. If I wait just a second, maybe I get an entry like here. I'm talking about 2 or 3 tick difference. So you're not under tremendous stress to take an entry. In fact, most of the time we find that you get clues within the order flow that happens at these inflection points will happen over 1, 2, or even 3 bars. So this bar is a 15-minute bar. If it happens over 3 bars, that's 45 minutes. Okay, you got plenty of time to make a decision as to what you want to do. Yes, you can use this on a 5-minute. We actually, on an ES, I use a 7-minute. Okay, 5-minute, any time frame, 5-minute, 10-minute, 15-minute, 1 hour. I don't recommend using it above a 1 hour. This is really for determining whether a specific level is going to be a good entry or not, and it's very short term. It's short term. Now, if you're a swing trader, how are you going to use this? Well, if you're a swing trader, you have already predetermined an area that you're interested in. So you already have this trade location in your mind. So when price gets there, as a swing trader, I know when price gets to, I'll give you a great example, on the euro right now, we're at 106, right? Well, if this thing bounces back to maybe 108, I'm going to take a swing trade on it short. I know that's my magic number is 108. So when price actually starts moving towards 108 and gets close to it, I'm going to look at the order flow just to make sure that I really want to put that position on at 108. And I'll put the position on if the order flow confirms my trade entry, my trade location. Now, as a swing trader, I'm not nearly as concerned about the time period, okay? So this time period here, because time doesn't make too much difference when you're swing trading. You know, you're going to hold it for a day or two, a week, couple of weeks. But why not use this information to get a really good entry at a low risk? So maybe that 108 is not, it comes screaming up to 108, and I say, oh, whoa, way too much momentum. Maybe I should go short at 108.50 instead of 108 even. Maybe there's another Fibonacci that's higher up, or maybe there's some other reason for me, some other support or resistance. That's what you can use. You can use it for swing trading, day trading, and scalping. The smallest time frame that I would put it on, on crude oil, I put it on a 3-minute. If you're scalping and you're looking at a 1-minute chart, you know, it'll work on a 1-minute, but it's going to be much more diagnostic on a 2, 3, or 4-minute. You need to have a little bit more data on those candles. So the order flow becomes the confirming piece of the puzzle. Okay, so what we want to do, we want to do our research. We find that trade location. Yeah, sure, if we're day trading, we're going to want to stay in one of our time periods. If you're on a higher time frame like a swing trader, you still want to confirm that that trade location is the spot that you want to take that trade. And the order flow will tell you a tremendous amount about human behavior that's currently happening in the market. Let's see where we're going. Okay. So here's that same chart unmessed up with all the other stuff on it. So let's look at some of the things that are telling me to go short when it comes up to my trade location. Here, remember, here's our signal bar right here. Okay, so what are these numbers right here? That is the net delta of that particular candle. So at a glance, I can see who the aggressive, are the aggressive buyers winning or the aggressive sellers winning. 2,572, this is the net aggressive sellers versus a net aggressive buyers. So it's positive here, so I know that the aggressive buyers are winning the war. So every one of these has a number above it. 3740, 3747, 4614. Lots of information. What else can you derive from this? Well, when the delta gets too big, see how this delta is 4,000, 4,014? That's pretty large when it comes to the ES. Anything over about 3,000 is, 3,000, 4,000, I would say, is starting to approach a lot of buying or a lot of selling. Now, what can we defer from that? If we have a really high number, like this 4614 here, that's big. That's a lot of buying going on. That's probably getting close to a climactic high, an intermediate exhaustion point for the buyers. You can't maintain that level of buying continuously. See, it went from 516 here, 2,500, 3,700, 4,600. Then look at this one. Bam! Complete reversal. Complete reversal. So there's pieces of order flow coming in here that also is telling me that when I get to this trade location, I need to be thinking about a short. Currently, this program is only available through NinjaTrader software. So that is the NinjaTrader charting platform is the platform that this is built for. Now, TD Ameritrade or Thinkorswim will allow you to use NinjaTrader. So if you have a Thinkorswim account, you can use NinjaTrader with that. And that currently is the only platform this is set up for. So it's not, we do not have it for TradeStation. It is strictly NinjaTrader at this point in time. Good question. Where we're going with this, there's pieces to the story. So there is a short story, and this is starting to give me short story evidence. So when I get here, I'm not just looking for this. I'm looking for the entire contextual story of the order flow leading into it. And this is very, very important because order flow can be a little tricky. It's hard to interpret what's going on. But let me tell you, order flow is the DNA of the market, okay? It's fact. It's not fiction. There's no monkey business going on. These are actual executed contracts, okay? This is the evidence left behind. Of course, we can also see this forming in real time. But from a detective perspective, this is the holy grail. Everything you need to know about whether to take a short or whether to take a long is in the footprint. Now, there's additional things on this footprint that if we have time, I will continue to enunciate. For instance, you can see we have blue numbers. Here's a blue number, a stack of them. These are buy imbalances. Okay, so we're identifying when there is an unequal or a exceptional amount of buying within the candle. Again, adding context to what's going on. Okay, if I see a lot of blue numbers or a lot of red numbers, I need to pay attention. So you see above the candle here, you see this 2 by 0. It's basically saying, hey, there's 2 sell imbalances to 0 buy imbalances. Now, if I'm already short, that's really good. That's really good. However, if for some reason I've gone long in here and I see this double stack of selling, that's telling me to get out. It's telling me that there's momentum to the downside. So what's cool about order flow is that not only can we use it to find the best entry, to devise and interpret the story of the contextual things that are going on in the market leading up to that trade, but once we get in that trade, the order flow will continue to add support to our position size, or not our size, but our direction. So if we go short, we're going to be watching for a change in that story. So as we come up with a short story, we take a short trade. Now I'm looking for story pieces that are anti my trade. And if I see those, I'm going to start thinking about getting out. So I'm short here. There's a yellow or a gold number here that's highlighted. Now, this is very interesting. First of all, that 927, that's what? That's aggressive sellers, right? That's aggressive sellers. This is aggressive sellers. But why are all these people at the very bottom of the candle? Well, that's your retail traders who are late to the party. Okay? They've seen it peak out. Uh-oh, big bar down. Oh, crap, I need to get into this thing short. Get me short, get me short, get me short. Right? And that is called a retail trap. Okay, that's where retail traders get trapped. This is the first inkling of I need to be thinking about exiting my short and possibly going long. Okay, so when I see a large number like that at the bottom of a candle, those are clues that my short story may be coming to an end. Because if you have a trap, what's going to happen? How do traps work? They're real quick reversal points. Okay, so what happens is a whole pile of retail guys come in and they sell, and if it doesn't continue to go down right away, they're going to bail out. So many times you get a whoop thing like that going on. Well, if you're already short, I don't want to tolerate that bounce. So when you see a trap or multiple traps, I start looking for a reason to get out. And look, right there's the reason to get out, right there. A blue number. That's a buy imbalance, and it's at the bottom of the candle. Now, we've only been talking about tops of candles, seeing the buy pressure go down and sellers coming in, right? That was what made us take a trade up here. What's going on right here? Here's the sell side. This is the aggressive sellers. There's 1,213. Next price level down, 735. Next price level down, 46. Is the sell pressure declining? Yeah. What? Wait a minute. You can see the sell pressure declining? Yeah. Now, how does this happen? Why does this behavior occur? Okay, this is real simple. This one has happened to me 100 times. I used to be in the construction industry, and I at one time had 3 crews. And of course, that means I had 3 trucks, 3 giant toolboxes, 3 ladders, 3 of everything, right? So my basement is packed full of construction tools because, let's face it, when you try to sell a used tool, they're just 10 cents on the dollar, right? So had a garage sale a couple months back, and I had 4 or 5 hammers. I'm like, Troy, what do you need 4 or 5 hammers for? You know, they're the same basic hammer. You need 1 hammer. So I put 5 hammers out for sale, and these are nice hammers. These are framing hammers. Okay, so for you guys who are not construction guys, a really good, heavy framing waffle head hammer, they're going to cost you $50 with a nice handle or more. So I've got these framing hammers for sale, and I've got $10 on them. And a guy comes up and he says, I'll give you $1. I'm like, that's a $50 hammer. I'm already discounted it to 10. Now, I don't need a hammer that bad. I'm only going to pay $1. Guess what? The price is so cheap that I'm not going to sell it. So when price goes down to a certain level, nobody wants to sell. It's pretty simple. So you know what the end of the story is. I still have 5 hammers in my garage, in my basement. My wife's still annoyed at me. She's like, take the $1. No, I'm not doing it. So as price goes down, less people are willing to sell. And what does that do? All of a sudden now price becomes cheap. It becomes low enough that it's at a discount, and buyers step in. There's my buyer stepping in. That's a blue $3.99. Blue $3.99. Okay? So the same exact thing happens at the top of the candle as happens at the bottom of the candle. The selling pressure drops, price gets too cheap, buyers come in. $3.99, $1,100, $2,600. You see that increase, decrease. It looks like this. Pressure, pressure, pressure. Pressure, sellers go down, buyers come in. You get that little U shape. And you can use this information to get out of your trade. So order flow becomes the king daddy for managing risk. Okay, so we use it for our entry and we use it for our risk, position and risk management. Okay, we talked about it. I'm skipping ahead. In fact, Renee has given me the 5 minutes, so I am actually going to skip ahead to trade. Instead of a trade of the day, I'm actually going to go to a trade that I did on Wednesday. Okay, so let's go back. Oops, discard. Here is actual chart. This is in the software. A trade on Wednesday. One of my favorite trades is a double top. I love shorting. But I'm not going to blindly trade a double top, just have an order parked there. I want to wait and see if that double top is actually a reversal point. Now, it also helps that I have one of our trade locations in this dotted blue, brown line here. And at the top here, what do I get? I get a sequential decline. And 4,000 on the delta. Next bar, 547 neg, 542 negative, and I get some red numbers. This is a perfect place to take a short. Yes, it's a double top, and the order flow is confirming that it's a reversal point. Okay? This is from Wednesday. Every single day, there's 2 or 3 trades in the mornings, and you'll see that this one is in zone 3. So one of my time periods all comes together. Makes it very, very common. Also, look at the top right here, 25.94. That's a huge number. That is a buy trap. So I've got buyers who are trapped up here at the top. This is a no-brainer. This is sold. Shoot it. Take it. Okay? Very, very cool. Okay, so we're going to go back to PowerPoint here. Got to wrap things up. Order flow is the answer, people. It is going to open your eyes to trading like you've never been able to see before, to analyze what the behavior of the market is. All you have to do is click on this link here, write it down, go to a free demo. It's a soft sell. We don't do any hard sells at all. If you don't like it, don't buy it. Okay, it's pretty simple. No pressure. Check it out. Go to the live demo. Thank you so much for your time. Have a great day. Happy trading.